Thanks a lot for that, Ritu. Well, by the way, we have the numbers of HCL Tech that are flashing for you on the screen. And it looks like pretty much inline set of numbers, actually. On the profitability, it was looking a little bit better. But, if you just pull up the margin number, I think we're working with a number of closer around 18.4% or thereabouts. It's coming at around 18.2. The profitability is a little bit better. And I think the revenue number is almost in line with the poll, bang in line with the poll. So, those are the broad numbers that we have out there. Top line, bang in line. The EBITDA number is very, it's a miss of close to around 2% in comparison to our poll. That's what leads margins to come in at around 18.2% in comparison with around 18.4%. The profit number, it appears there is a bump up because, maybe something below the operating line. But those are the broad numbers. Rima will join us in just a bit to fill us in with more details on that. Remember, the street was bracing for a weak set of numbers. But how much of that bad news is already in the price? These numbers look pretty much in line. We're waiting by for the guidance as well. But I think these numbers will go in as an inline set of numbers. Rima joins us as well. Rima, tell us, what's your first take on these numbers?
Well, still awaiting what the constant currency growth numbers are, but just purely based on the rupee revenue, the margin and the profit number, it's largely in line. There is a bit of a miss on the company's margins, but I think it would be digested by the street because after the TCS numbers, the stock has fallen. After TCS and Infi, the stock has anyway corrected by close to about 5 to 6%, which basically means that estimates have already been pared down. So it needed to be a very big miss for the markets to be surprised on the downside. And just purely going, in the rupee revenue number and the margin and the profit number, the key is the margin performance. Because on the top line, we typically look at the dollar revenue and the constant currency revenue growth. That is the more material revenue number rather than the rupee revenue. So out of the three numbers that we have, the key one is margins. And yes, margins have contracted by 140 basis points on a quarter-on-quarter basis. Correct. But we've seen both Infi and TCS miss on the margins, and that's because the top line has been missing. And the costs continue to remain sticky. So if your project gets deferred, you're not getting in the revenue that you were anticipating, but you have still staffed your employees on that project.
Right.
So that's the reason why companies have been missing the mark on the margin front. But, both Infi and TCS had missed margins by 50 basis points compared to expectations. HCL Tech has missed by 20 basis points. So I think purely, because that's the only number I'm going to be talking about right now, because compared to the other numbers, this is the more relevant one. I think it's a 20 basis points miss on margins, sharp margin contraction of about 140 basis points quarter on quarter. But I think it's something that the street would have braced itself for, that there is going to be a minor miss compared to expectations which were set prior to the commentary that we heard from Infi and TCS. The bottom line number looks a beat compared to much better. And that's because the other income has gone up on a sequential basis. The other income is at 453 crore versus 260 crore.
All right. So, Rima, I'll give you a chance to further look into those numbers. For the time being, I think we're joined by the head of research at Reliance Securities, Mitul Shah. Hi, Mitul. Good evening. Thanks so much for joining in. I'm guessing that you also would have had a brief look at HCL Tech. Valuation-wise, it has some comfort out there. Going into these numbers, the stock has seen quite a sharp correction as well. Your view?
Yeah, hi, good evening, Nigel. Thanks for having me on CNBC. Yes, numbers seems to be more or less in line with estimate. Marginal miss, but as Rima pointed out, that the expectation after these two results were there would be a decent miss, but as compared to that, it is marginal miss, which can be considered as a key positive. Going more into the detail, what I am finding is that IT service business revenues have increased Q on Q. So impact is coming primarily from ERD business and this product business. So there is a seasonality impact always for the product business in Q4. So considering that, IT service is doing reasonably good compared to other two companies which reported their number. Even margin-wise, segmental margin, if I am analyzing briefly, then still numbers are quite good for IT service segment.
Okay, so these numbers would go down as an inline set of numbers, and from the pecking order, since it has, valuation comfort, we'll have to wait by obviously to hear what the management has to say. But would you be a little bit positive on it?
Yes, compared to all these three results, this seems to be much better results. And as you pointed out, Valuation-wise, we are quite comfortable for this company. Only the thing is that as both the management of TCS and Infosys pointed out some cancellation of deals and execution delays, so those type of cautious commentary certainly we would expect from HCL also, but we need to gauge what level of cautiousness these companies highlighting compared to other two previous companies. Based on that, we can estimate our valuation. But overall, within these three companies, valuation-wise, we are much comfortable on HCLT compared to. Deal win would be more important now, as and when we'll get that number. That will be important parameter to decide outlook for 24-25.
Okay, still awaiting what the guidance number is going to be by HCL Technology along with Infosys. Remember, HCL Tech also gives you a quantitative FY24 guidance. Infy had guided for a 4 to 7% growth. For HCL Tech as well, street expectations are between 5 to 7%. So a growth rate close to Infosys is what the street is anticipating. That's going to be the key number to track from here on, the guidance on revenues and the guidance on margins. Secondly, watch for the deal wins. Is there any slowdown that we are seeing? Okay, some numbers are coming in. We've got the guidance, and I think this is going to look like a good set of numbers based on the guidance. The revenue guidance is seen between 6 to 8% on a constant currency basis. 6 to 8%. This compares with 4 to 7% that Infosys had reported. Now, HCL Tech gets about 90% of its revenues from services business, which is directly comparable to Infy and TCS. They also get about 10 to 12% of their revenues from software or products, right? So this is where it's a little different. So the guidance that I'm giving you, 6 to 8%, is a good guidance in line with what the street was anticipating. Given the macro environment, 6 to 8% is the top line growth guidance. But for services, which is 90% of their revenues, the company is guiding for 6.5 to 8.5% revenue growth. And this will provide some comfort. I think the street was fearing that after Infy's guidance of 4 to 7%, maybe HCL Tech would also veer towards numbers closer to the bottom end. But a 6.5 to 8.5% growth is actually better than what Infosys is likely to report. So this guidance is not as bad as what the street would have feared. The second important number is the margin guidance. The margin guidance is a narrow 18 to 19%. It's not the 18 to 20% that the street was anticipating. So, once again, margin improvement that the street was hoping for in FY24 is not going to be very meaningful. In FY23, we don't have the actual number, but HCL Tech's margin should be closer to 18%, which means in FY24, margins will see a slight improvement, 18 to 19% margin guidance. Lots of numbers I'm throwing at you, but in a nutshell, HCL Tech's FY24 guidance is not as bad as what the street was fearing. It's actually closer to the upper end of the street expectations. 6 to 8% consolidated revenue growth. Services, which is 90% of their revenues, is going to see a growth of 6.5 to 8.5%, and margins are seen between 18 to 19%. So the upper end of the margin guidance band has not really been raised in the case of HCL Tech as well. But then when your revenues are still growing in mid-single digits, it's hard to get the operating leverage which is required to improve the margins meaningfully. Omkar Tanksale, the senior research analyst at Axis Securities, is with us on the show. Omkar, how would you read HCL Tech's FY24 guidance, and how does it compare with what you were expecting?
Yeah, it's definitely, it is in line in the range that we were expecting. And, the first thing that, as compared to Infy, one thing should be considered, Infy is more on a conservative side, and they can, increase the guidance as, in the latter half of the year. But coming on to the HCL Tech again, it's still in the range. I believe 6 to 8 is just a 1 to 2% higher than the Infy's guidance range. So it is much in line in our expectations as of now.
Okay, so the guidance is in line with what you were anticipating. Mitul, would you want to comment on the guidance by HCL Tech?
I believe that guidance is reasonably strong. It is in fact slightly higher than the street expectation. After Infy's guidance of 4 to 7%, Street expected it to be HCL also to be in the similar range or maybe slightly lower based on the past track record. But this is coming 6.5 to 8.5% for service business is really very big surprising. And very important point here in terms of employee addition compared to both the companies where Infosys was a negative in terms of there was a net reduction in employees, TCS was marginal increase. Here, there is nearly 4,000 headcounts they have increased in fourth quarter compared to previous, which is higher than the Q3 as well as Q1. So there is a positive net employee addition to that, 4,000 is more encouraging in terms of their outlook and their confidence on the business execution for FY24.
Okay.
Yeah, so just some more numbers. Q4 is in line with street expectation. Constant currency revenue growth has declined by 1.2%. This is bang within the 1 to 1.5% decline that the CNBC-TV18 poll threw up. So revenues have fallen 1.2%, but in line with street expectations, and the decline in revenues is largely on account of the normalization of the products business. HCL, as I said, gets about 10 to 12% of their business from products.
Yes.
Right? That had a 30% growth last quarter, which is not normal. So that 30% growth had to come down. And that's the reason why quarter on quarter, the revenues were expected to come down. But their services business, which is directly comparable to Infy and TCS, and about 90% of their revenues, that has seen a growth of 0.6%. So they have not declined the way we saw in the case of Infosys.
Yes.
TCS had a 0.6% revenue growth. HCL Tech has seen a services revenue growth of 0.6%. But Infy had seen a decline. So the numbers are not as bad as what the picture threw up in the case of Infosys. Yes, these are still modest numbers.
Yeah.
But it's not as bad.
So, Rima, just to get a few highlights in there, the numbers appear pretty much in line. The guidance appears like more or less in line as well. No disappointment coming in there. It has some bit of valuation comfort because of the correction that we have seen as well. And post the recent correction, the street would have been fearing that if we had two misses, let's hope that we don't have a big miss out here. And that seems to be the case as well. So pretty good showing, I think, from HCL Tech, given everything, given the current scenario. It's not a blowout set of numbers, but, no big fear has come through. And no fear is good news, I think, right now.
No, absolutely. Even the dollar wins, the deal wins. Deal wins are tracking above $2 billion. It's at $2.07 billion. The average over the last 4 quarters is 2.2. So not too far off, right? You assume some delay in decision making, some slowdown in decision making, but it's still 2.07. So a little bit of a decline in deal wins, I think, is a given in a macro environment that we're in. So the decline in deal wins is in line, a little bit of a fall. Their hiring numbers are also encouraging because in the case of Infosys, we had seen headcount dropping, and that is seen as a gauge of demand slowing down. But in the case of HCL Tech, their headcount has gone up by 3,600 employees, and the pure fresher number is actually more than 4,000 employees. So the headcount too has gone up, and attrition, like we've seen in the case of other companies, has seen a sequential decline. But this is something that we were anticipating. So, as you pointed out, on the whole, it's not such a bad performance from HCL Technology. Q4 is in line with street expectations. FY24 revenue guidance is seen at 6 to 8% on the top line, with margins coming in at 18 to 19%. Their deal wins are largely steady, holding above $2 billion. Attrition has come down, and the company continues to hire. The net fresher addition stands at more than 4,000 freshers on a quarter-on-quarter basis. We thank Mitul, for joining in, and Omkar for taking his time out and sharing his insights. Gentlemen, thank you very much for that. We're going to wrap up on this edition of Markets Today. Thank you for watching.